Welcome back. Kirloskar Ferrous is the next stock on our radar. The past quarter's numbers were weak. However, going ahead, they have some cost-saving plans which could help them in terms of their margins. To understand more, we have Mr. Gumaste, who's joining us on the phone line. Hi, Mr. Gumaste, and thanks a lot for joining in. Mr. Gumaste, give us a couple of details. Your casting business, earlier you were talking about around 1.5 lakh tons for the year. That doesn't seem achievable because for 9 months you've done only around 1 lakh tons. Could you tell us what should the revised guidance be on the casting business, and also if you could give us a volume number for pig iron as well as steel, an absolute number. Please go ahead, sir.
Yeah, thank you very much for inviting me. I think, as you know, the casting business, we have gone through sluggish demand from the tractor industry. We did one quarter very well. We went almost up to 38,000 metric ton in a quarter, but 2 quarters have gone soft. I am seeing some green spouts, and I expect this quarter to be better for tractor. There is better schedules. We hope to look forward to once again go back beyond 36,000, 12,000 per month. And if you see the market right now, I think commercial vehicles as well as tractors are doing well. Earth moving equipments are doing well. I hope that this should support us in achieving these numbers. And iron and steel industry, as you know, it's a terrible position. The margins are under pressure. Whereas volume, we have been operating all the 3 blast furnaces and selling full quantity. Marginally, it has been down compared to the third quarter of last year. But if you look at overall, last 9 months, we are up 26% on volume. And but we are only 9% up on the casting and tube. We are down by 3%. But overall, we have a small growth of about 4 to 5%. But I think we try to do better in the remaining 1 quarter to catch up with the numbers.
Okay, all right. So for your casting business, you should clock around 1.35 to 1.4 lakh tons for this year. With pig iron business should do around 5 lakh tons for the year. Should that be the gettable numbers?
Yeah, I think so. Yeah, those are the numbers we are looking at.
Right, which is a little bit lower than what you projected at the start of the year. But let's focus on the margin parameters. The hope is that realizations have bottomed out and they should start looking up. And also you have mentioned various, cost-saving measures with regard to coke, with regard to renewable energy as well, which should hold you all in good stead. Your consolidated margins have come down to 11%. What's the scope for improvement, and by when do you get to mid-teens margins, in the coming quarters?
If you look at the margins are reasonably maintained in case of castings as well as in case of tubes, though tubes have tapered down a little bit because the mix has changed. But the real impact is on the pig iron business. As you know, during the quarter, we have commissioned the oxygen enrichment, and we have also increased the pulverized coal injection from the level of 80 kg for the steel grade to 120 kg, and for the foundry grade from 50 kg to going up to 100 kg, 80 kg. So this increased pulverized coal injection reduces the coke consumption, and it brings down also the cost of manufacturing. We are doing whatever possible, but the market is what is not in our hands. And I hope that the pig iron market has bottomed out, and there should be some green spouts, and there should be some improvement. Basically, coming out of the steel, people not doing well, and they are
Mr. Gumaste, we understand that the steel industry. Mr. Gumaste, we understand that the steel industry is not doing well. You've made that point, and others also have made that point as well. But in that, the oxygen enrichment and pulverized coal injection, etc., these cost measures that you're taking, and also you are increasingly, sourcing your iron ore captively as well. If you could give us a sense of how much will all of this save on your costs, and irrespective of anything, what proportion of margin improvement should we see on account of these measures?
The first thing, let me quickly take the iron ore one. I think Bharat Mines is up and running. but we got only 3 months. I expect maybe we will consume 50,000 ton in this year. But going forward next year, we should be able to consume very close to at least 2 lakh tons of our own mined material. I expect a benefit of close to 40 crores coming because of this iron ore mining. I think another very important aspect which you touched, I would like to cover that is we have commissioned almost completely 70 megawatts of solar. 69 is what we are running right now. I think we will close that 1 megawatt shortly. And this is going to give us a substantial benefit. The benefit expected is 70 crores per annum. I think these are the two important measures other than the pulverized coal injection, which should give us the advantage and bringing the cost down.
So the cost savings will be nearly around 100 crores on the back of both these two parameters. Is that correct?
Absolutely right.
Okay, very quickly, sir, what is the net debt number in your books as of now?
Our debt numbers remain more or less same. It's in the range of long-term debt around 700 crores with short-term debt of about 300 to 400. Total, I think we are around 1,000 plus minus 100 crores in that range. No major change or increase over the last 1 year.
And it is peaked out at 1,000 crores, right?
Around 1,000 crores, yes.
All right. And Q4 margins will see an improvement versus Q3?
I think so. It has to be. Markets have improved. I will definitely try to get the better realization.
Appreciate you joining in, Mr. Gumaste. A weak quarter, but you're guiding for better times ahead. In FY26, we'll see a benefit of around 100 crores on cost savings. We'll hold you to that particular point.